Silver just hit $79 an ounce, not $80, not a round number that makes headlines. $79. And that specific price point is sending shockwaves through boardrooms from Silicon Valley to Beijing because it is not just a commodity spike. It is the signal that the entire technology sector is built on a foundation that is crumbling in real time. What if I told you this was not about precious metals investing? What if silver at $79 means your smartphone, your solar panels, your electric vehicle, and your entire digital infrastructure are about to get repriced by scarcity economics that governments cannot control? What if the state, the institution that promised stability and growth, is about to be tested by a metal that cannot print, manipulate, or substitute? Look around you right now. Every device in your life contains silver. Your phone has 0.34 grams. Your laptop has 0.5 grams. The solar panels government's mandate for climate targets contain 20 grams per panel. The electric vehicles they are forcing manufacturers to produce contain 50 grams each. At $79 per ounce, the math just changed. Not slightly, catastrophically. Drop a comment. Where are you watching from? Because this is not a regional crisis. This is the moment when physical reality collides with financial engineering. And that collision is about to reshape everything from tech stocks to sovereign debt. Hit subscribe for the unfiltered truth about what happens when the metal that powers modern civilization becomes more valuable than the currencies used to buy it. Let me show you the signal nobody is talking about. December 27th, 2025. Silver closes at $79.14 on the Shanghai Gold Exchange. COMEX opens hours later at $34.28. That is a 131% spread between physical and paper markets. Arbitrage should be instant. Buy paper in New York, deliver physical in Shanghai, pocket the difference. Except the arbitrage is not happening because Western vaults are empty, and Eastern buyers will not accept paper promises anymore. But here is what makes $79 different from previous spikes. This is not speculative mania. This is industrial panic. Apple, Samsung, Tesla, First Solar. Every tech manufacturer dependent on silver supply chains just saw their input costs explode. And unlike oil or lithium, there is no substitute for silver in electronics. Its conductivity, thermal properties, and antimicrobial characteristics are irreplaceable. Sound familiar? This is what happened to palladium in 2019 when prices spiked from $1,000 to $3,000 per ounce. Automakers could not build catalytic converters without it. Production slowed. Prices for vehicles rose. Supply chains fractured. But palladium is used in grams per vehicle. Silver is used in kilograms across entire product lines. The scale is exponentially larger. And tech companies cannot hedge anymore. Futures markets are in backwardation, meaning spot prices exceed future prices because nobody believes paper contracts will deliver physical metal. When hedging breaks, manufacturers face raw material risk with no insurance. That forces production cuts, layoffs, and price increases. The signal at $79 is that tech's growth story just became a scarcity story. But there's a darker signal buried in that $79 price. It is testing whether governments can still control commodity markets through intervention. And the answer is revealing institutional weakness that should terrify anyone holding government bonds or fiat currency. Let me show you why states are panicking. Between 1971 and 2024, governments maintained control over precious metals through three mechanisms: paper market suppression, central bank leasing, strategic reserve dumping. When gold or silver prices spiked, central banks would lease metal to bullion banks who sold it to suppress prices. Governments would release strategic reserves, and paper markets would flood with futures contracts to overwhelm physical buying. It worked for 54 years. But in 2025, all three mechanisms failed simultaneously. Central banks do not have reserves to lease anymore. The United States sold its strategic silver stockpile completely by 2002. China, Russia, and India are not selling. They are accumulating. And paper markets lost credibility when Shanghai prices diverged from COMEX by 131%. The state's ability to control silver prices died at $79. And if they cannot control silver, what else can they not control? Currency values? Bond yields? Inflation expectations? The signal is that government intervention, the foundation of modern monetary policy, is breaking down against physical scarcity that no amount of printed money can solve. Sound familiar? This is the same crisis that collapsed Bretton Woods in 1971. Foreign governments demanded gold redemption for dollars. The United States did not have enough gold. Nixon closed the window. The dollar became pure fiat. But this time, there is no window to close. Silver is already in private hands, embedded in industrial supply chains, and accumulated inside sovereign wealth funds. Governments cannot confiscate what they do not control. And that loss of control is the real signal at $79. Let us break down exactly how $79 silver breaks tech and tests the state. Start with the industrial consumption math. Global tech manufacturing uses 420 million ounces of silver annually. At $25 per ounce, that is $10.5 billion in annual costs. At 79, it is $33.2 billion. That is a $22.7 billion cost increase, hitting every electronics manufacturer simultaneously. But it compounds. A smartphone at $25 silver contains 0.27 of silver. At $79, it contains 0.85, so that is 0.58 in added cost per unit. Apple ships 230 million iPhones annually. That is $133 million in added silver costs alone. It sounds manageable until you add memory chips, batteries, and circuit boards, all of which are silver intensive. Total added cost per iPhone is between $180 and $240. Multiply that across all products, all manufacturers, and all markets. The cost shock is $18 billion annually just for smartphones. Now scale this to electric vehicles. Each EV contains between 25 and 50 grams of silver in electrical systems, charging ports, and battery management. At $25 silver, that is $20 to $40 per vehicle. At $79, it is $63 to $126. Tesla produced 1.8 million vehicles in 2024. At $79 silver, that represents $113 million in added costs annually. But Tesla's operating margin is only 7.9%. A $113 million cost increase with no pricing power means margin compression, production cuts, or both. Solar panels are worse. Each panel contains 20 grams of silver in photovoltaic cells. At $25, that is $16 per panel. At $79, it is $50. Global solar installations reached 420 gigawatts in 2024, requiring 140 million panels. That translates to $4.8 billion in added silver costs. For an industry already operating on razor-thin margins and dependent on government subsidies. Sound familiar? This is cost-push inflation. Input costs are rising faster than companies can pass them through to consumers. Unlike demand pull inflation, which central banks can fight with interest rates, cost-push inflation is supply-driven. You cannot lower silver prices by raising interest rates. You need more supply. But silver supply is inelastic. Mining production takes 7 to 10 years to ramp. Recycling recovers only 15% of industrial silver. There's no quick fix. And here is where it breaks tech completely. Technology companies are valued on growth multiples. Apple trades at 32 times earnings. Tesla at 76 times. Nvidia at 51 times. These valuations assume continued margin expansion and unit growth. But when input costs spike by 216% and cannot be passed to consumers, margins compress. Growth slows. Multiples contract. A stock trading at 50 times earnings that experiences a 5% margin compression sees its valuation cut by 40%. The signal at $70 is that tech's valuation bubble is colliding with physical constraints. Software can scale infinitely, hardware cannot. And every AI server, every data center, and every 5G tower requires silver that is now priced at $79 with no ceiling in sight. When the market realizes this, tech stocks do not correct. They crater. But the state is being tested even harder than tech. Governments worldwide have committed to green energy transitions that require massive silver consumption. The European Union, OS Green Deal, mandates 750 gigawatts of solar capacity by 2030. That requires 210 million panels consuming 4,200 tons of silver, roughly 135 million ounces. At $79, that is $10.7 billion just for silver and solar panels to meet one policy goal in one region. The United States Inflation Reduction Act subsidizes electric vehicle production with $7,500 tax credits per vehicle. But if silver costs make electric vehicles unprofitable to manufacture, subsidies do not matter. You cannot subsidize production that is economically unviable. The state promised an energy transition. Silver at $79 is forcing governments to choose. Abandon climate goals or print money to subsidize manufacturers through cost shocks. They will choose money printing. They always do. But here's the test. Printing money to subsidize industrial production does not increase silver supply. It only debases currency while physical scarcity persists. That is stagflation. Rising prices with stagnant growth. And stagflation is the worst outcome for sovereign debt because interest payments explode while tax revenues stagnate. Global debt is already at breaking points. United States federal debt stands at $36 trillion with interest costs exceeding $1 trillion annually. Japan's debt to GDP ratio is 264%. European sovereign debt totals $14 trillion. When silver-driven cost shocks force central banks to print money, bond markets panic. Yields spike. Debt becomes unsustainable. The state's fiscal capacity is being tested by a metal priced at $79. Let us talk about the mechanism connecting silver at $79 to a sovereign debt crisis. When manufacturing costs spike, economic growth slows, tax revenues decline. But governments are already committed to spending on subsidies, social programs, and debt service. The gap between revenues and spending widens. They issue more bonds. But bond buyers demand higher yields to compensate for inflation risk caused by money printing. Japan is the canary in the coal mine. The Bank of Japan owns 53% of all Japanese government bonds through quantitative easing. When yields rise, the BOJ faces mark-to-market losses on its bond holdings. If it sells bonds to defend the yen, yields spike higher and crush the economy. If it keeps buying bonds, the yen collapses against hard assets like silver. They are trapped. The signal at $79 is that this trap is global. Every central bank that used quantitative easing to suppress yields is now facing a choice between currency collapse and bond market collapse. And silver, the metal they cannot print, is forcing that choice faster than policymakers can coordinate a response. Here's the greed that makes this unstoppable. Hedge funds see governments trapped. They are shorting sovereign bonds and going long physical silver. It is the ultimate macro trade. Bet against the state's ability to control markets while owning the asset that exposes its impotence. George Soros broke the Bank of England in 1992 by shorting the pound when it defended an indefensible peg. Modern funds are doing the same trade with silver versus fiat currency. But unlike 1992, this is not one country. It is the entire Western monetary system. And the state cannot fight back with interest rates. Rates are already restrictive. The Federal Reserve's funds rate is 4.5%. The European Central Bank is at 3.5%. They cannot raise rates without triggering recession. They cannot cut rates without accelerating inflation. They are paralyzed. And silver at $79 is the proof of that paralysis. If central banks could suppress precious metals prices, they would. The fact that silver trades at $79 on physical markets while paper markets pretend it is $34 shows a complete loss of control. The state ES monopoly on money is being challenged by a metal that industrial civilization needs but governments cannot create. Sound familiar? This is the gold standard debate in reverse. In 1971, gold constrained monetary policy, so governments abandoned it. In 2025, silver constrains tech production and green energy policy, but governments cannot abandon it because modern civilization runs on it. They are trapped between physical scarcity and political promises, and the trap is tightening. Let us quantify the breaking point. Global above-ground silver inventory is 1.1 billion ounces. Industrial demand is 678 million ounces annually. Investment demand is 241 million ounces. That is 919 million ounces of demand against 830 million ounces of annual production. The deficit is 89 million ounces per year. At current rates, inventories reach zero in 12.4 years. But demand is accelerating. Electric vehicle production is projected to grow 340% by 2030. Solar installations are growing at 18% annually. Electronics consumption is growing at 8% annually. If demand grows at projected rates, the deficit reaches 150 million ounces annually by 2028. Inventories hit zero in 7 years, not 12. When inventories hit zero, there is no buffer between production and consumption. Any supply disruption causes immediate shortages. Mine strikes, refinery shutdowns, export restrictions. Manufacturers cannot build products. Supply chains freeze. Governments then face a choice. Ration silver like a wartime commodity, or let markets price it at whatever level clears supply and demand. At $79, the market is front-running that choice. It is pricing the probability that governments will lose control and that physical scarcity will determine price instead of monetary policy. And every day silver stays above $75, that probability increases. Because at $75 and above, mining is maximally profitable, yet supply is not increasing. That proves supply is physically constrained, not economically constrained. Here is the engineered collapse. Western governments spent 50 years suppressing precious metals to maintain fiat currency credibility. They leased silver from strategic reserves to bullion banks, who sold it to industry at suppressed prices. That subsidy kept tech manufacturing costs low and made digital transformation affordable. But reserves were depleted completely. The subsidy is gone. The true cost of silver is now being discovered by markets, not set by policy. And the true cost at $79 breaks the state's promises. They promised infinite growth through digital transformation. They promised climate solutions through renewables. They promised financial stability through central bank intervention. All three promises require silver that does not exist in sufficient quantities at prices they can control. The signal at $79 is that physical reality is overriding political fantasy. States cannot legislate more silver into existence. They cannot print it. They cannot manipulate it through derivatives anymore. The mechanism that maintained control for 54 years is broken. And when states lose control of critical commodities, currencies lose credibility. This is the test. Can the state maintain trust in fiat currency when the metals that power civilization are repricing 200% higher? Can governments deliver on policy promises when input costs make those policies economically impossible? Can they service debt when inflation and stagnation arrive simultaneously? History says no. The Roman Empire debased the denarius when silver mines depleted. Weimar Germany printed marks when productive capacity collapsed. Zimbabwe printed dollars when commodity exports vanished. Every time the state faced the choice between admitting failure and printing money, it printed. And every time, currency holders paid the price. Silver at $79 is forcing that choice again, except this time it is global, and the alternative to fiat is visible in real time. Gold at $2,800, Bitcoin at $105,000, silver at $79, all signaling the same message. Paper claims are being repriced against hard assets. And the repricing is accelerating. The Western financial system is built on debt, leverage, and the assumption that central banks can always intervene to maintain stability. Silver at $79 is testing whether that assumption still holds when physical constraints override monetary policy. And every day the test continues. Trust erodes. Bond yields rise. Currency values fall. Capital flees to assets governments cannot debase. Denial is not a strategy. Hoping governments regain control is fantasy. The institutions that promised growth, stability, and prosperity were built on the assumption that commodity prices could be managed through intervention. Silver at $79 proves they cannot. And when one assumption breaks, the entire structure becomes suspect. So here's the final question. Are we wiser now, or are we walking the same path in better suits? Drop your thoughts below. Share this with someone who thinks tech stocks will keep rising forever. And subscribe. Because when silver crosses $100 and industrial production starts getting rationed, you will want to understand what happens to currencies backed by governments that cannot deliver on their promises. The signal is clear. The test has begun. Choose which side you are on.